Good afternoon, everyone. Thank you for attending our presentation this afternoon. Today's presentation is going to be on how to obtain a home mortgage and down payment assistance programs. Presenters today are going to be myself. My name is Terry Davis. I'm the lending manager at Hacienda CDC. We also have Emilio Morales. He works for US Bank, and Guillermo Salazar with Country Financial. So we're going to go ahead and jump into our presentation. Please use the chat box if you have any questions along the way. We'll be stopping from time to time and addressing questions that you might have at this time. So Hacienda is a nonprofit organization that we've been around since 1986. We are a Latino community development corporation that strengthens families by providing affordable housing, home ownership support, economic advancement, and educational opportunities. So we're going to be talking about frequently asked questions. And again, please feel free to ask any questions along the way in the chat box. You are all muted, so we can't hear you. So please put any comments or questions that you have in the chat box. Next slide, please. Emilio?
Hello, everyone. This is Emilio Morales, US Bank Home Mortgage, and I'm gonna go over to some of the questions that you might have. You're wondering what's gonna be involved in the process of getting a mortgage. So one of the questions that everybody is kind of asking all the time is, do I need to get great credit to get a mortgage? That's an excellent question, but you don't need to have a super excellent credit score to get a mortgage, because there are programs that can allow you to get you on a moderate kind of credit score, and it's all based on what is your activity on your credit. If you have used credit before and you have some movement there, you probably have a decent score, so you don't need to be concerned about what's your credit. But the best thing that we need to take care of is make sure that we have run your credit and see how it looks like. We can start to tailor and everything else. Now, when we look at the credit, we see the history of the credit, and it's a few things that we lenders like to look at it. First is your capacity. So what that means is the way that you're gonna generate income, and it has to be consistent. If you are having an incremental from year to year, that's gonna be absurd. Let's say you make 20,000 on 2018 and you make 50,000 on 2019. We would like to see what is going on, why you have that big differential. But it's important to have that ability to show, and we're gonna go over to the character, which is actually another point that we see is how you're gonna repay the loan that you're asking for. And it's basically based on what your ability to repay is, looking up to your taxes, looking up to your income, looking up to what is the way that you can prove that you have a way to repay the loan back. And we have to see the collateral. What is the collateral property? Is the place that you're trying to buy. You're trying to buy a home, and that's the collateral. And we need to see your assets, which is the capital you have. If you have some already put aside, some savings for the down payment, for taking care of your closing costs, and also if you are ready to go ahead and have this purchase going. Although we're gonna talk about some ways to assist you to get the down payment ready through this class. Next slide. How much do I need as a down payment? Well, you can start with a minimum of 3%, and this is actually a conventional loan. There are some other loans that are actually, you can go ahead and put maybe 3.5%, which is a federal loan called FHA. FHA is a great loan, but also what it does is coming as more like an insurance. What that means is you will have to keep that loan or that extra payment that you have to make through that insurance through the life of the loan. It doesn't disappear by itself. You probably have to refinance your loan to get that one disappear from your mortgage. But on a conventional loan, which is actually a really good loan and it's based on credit and the down payment as well, you can go ahead and think that if you build enough equity and you also contribute to pay more money to the principal, you can actually disappear an insurance that instead to be a mortgage insurance premium on the FHA will be just a mortgage insurance. The minimum down payment is 3%. On an FHA, it's 3.5%. But there are some other loans. If you're a veteran, we have a VA. There are some other loans like a USDA that you can also use as a no down payment. And those are really great loans too. And along with that, if you only have just a little bit of money set aside, again, you can ask for assistance, which is going to be the down payment assistance program that we're going to talk about ahead.
Okay, thank you, Emilio.
Mm-hmm.
So before we move on to the next slide, I'd like to ask, are there any questions, Ceci, that we need to answer that folks have been asking?
Yeah, let me unmute myself. So someone asked, they just changed jobs within the same company and because they got a raise, would that be counted toward the work history?
Great question. Yes, actually, so lenders are looking for a 2-year work history. We'd like to see that it's in the same industry. So it is absolutely possible if you've got a promotion within the company, something like that, then absolutely. Even if you change companies and it's in the same line of work, that is an acceptable source for an employment history. Any other questions?
Yeah. What about people who have an I-10?
So folks who have I-10, we do have resources for financing. Typically speaking, with those programs, they are higher interest rates. They do require a larger down payment. There's certain documentation that has to be provided to the lender as well. Yeah, so we can help with some of those I-10 borrowers. There are certain credit trade line requirements for certain length of time to show that you have established credit under that I-10 number.
Okay. And how much money do I need for a down payment?
Depends on the loan program that you are trying to qualify for, as Emilio had mentioned in the previous slide. So for conventional, the minimum down payment for conventional financing is 3%. On FHA, the minimum down payment is 3.5%. As he mentioned, with VA and USDA financing, it is 100% financing, so zero down for those programs. There are also credit unions and banks that offer programs within their organizations that have 100% programs as well.
Okay. Can a pension plan be considered capital?
So pension and retirement accounts can be considered assets. If you're using, as an example, if you're using a 401k account to use for, say, down payment and closing costs, that is an acceptable source for down payment and closing costs. You can either sometimes withdraw from those accounts, or you can take out a loan and pay yourself back. If you choose that option, we have to have documentation to show how much you've borrowed against that account and what the monthly payment is, because it does have to be counted in your debt ratio.
Somebody wants to know if they qualify for DPAL even if their partner has already purchased a home, but they are a first-time home buyer.
If they are not on the loan that the partner purchased, and they will reside in the home, we would have to look at the documentation to see if they meet all the requirements, because they cannot be a homeowner within the last 3 years if they file their tax returns and show mortgage interest on their tax returns, and they are not considered a first-time home buyer. And then we also have to look at income qualifications and some other things too.
Okay. If I have an I-10 and I only have one credit card, is that enough to build credit?
Typically speaking, they want to see at least 3 trade lines. Most of the time they want to see that it's, some of them are, have been open for a minimum of 2 years.
I have one question. I'm sorry, Ceci. What is the minimum credit score to qualify for a loan?
The minimum credit score varies depending on the loan program that you're trying to qualify for. So it would really depend. It's very specific to the loan program. So there's not like a general, you have to have a 620 to apply for any type of a loan program. It really varies from program to program.
If someone wants to purchase in January, is it a bad time to get a credit card to build credit?
Typically speaking, lenders look for a 12-month history for trade lines. They typically look for 3 trade lines rating for that period of time at a minimum.
Okay. What programs does Hacienda have available for I-10 borrowers?
We do have some programs for I-10. So we would have to look at your case specifically to see if you meet the requirements for that program. Okay, so the next thing we're going to talk about is, so we've discussed things like what are minimum down payments, that type of thing. So even if you get a loan, let's say that is 100% financing, and you're not required to pay a down payment, or even if you are the 3 or 3.5% that we mentioned, in addition to your down payment, you do have closing costs. So closing costs are things that, fees that are going to be charged to you for doing the loan. So things that are included in closing costs are going to be things like credit report fees, appraisal fees. They're going to be like title and escrow fees. There will be a fee for recording the deed of trust that's recorded in the county recorder's office, which shows that you are owner of that property. Other things that are going to be part of the closing costs will be things like an escrow account for your homeowner's insurance and your property taxes. That'll be set up in the beginning as well. So basically it refers to all of the charges that you'll need to pay before your loan is complete. So anytime you purchase a home or you refinance a home, you will have closing costs.
Should I choose fixed rate or an adjustable rate mortgage? That's an excellent question, and it's always been up in the air. What is better? We always, if you're a first-time home buyer, will recommend that you go ahead and try to get a fixed rate. Why is that? Because in that way, your principal and interest won't change. Things that I can change are always going to be the tax properties. Why is that? Because anytime, every year, the county that you are living, it might arrange or change or increase your property taxes. Now, with the COVID-19, we're seeing a lot of the situation changing. Why? Because COVID is just probably gonna have an impact on the property value. And that's probably, one of the things that they see on the assessments that they receive every year for taxes. An adjustable rate is also an option, but it's not really, you can actually get an adjustable rate if you are, let's say, I'm planning to be in this house for the next 5 years or 10 because my job, or maybe because you have different plans. I'm gonna just go ahead and have this instead to be paying rent. I wanna be here for 10 years and I go ahead and change it over for something else. But adjustable rates are most for people that actually are investors. And they don't care about the changes sometimes because they have a plan already for that type of property. But in your case, if you're gonna be a first-time home buyer and this is gonna be your primary residence, we encourage you to get a fixed rate so that way it won't be any changes on your principal and interest.
So one of the questions that we talk or hear a lot is, should I lock my interest rate? So locking an interest rate basically just means that it protects you from interest rates going up or down. So once you are in contract, you have an accepted offer on a contract, you're going through the process of getting your loan, you are subject to whatever the market is doing at the time. So if interest rates go up, you're subject to that. If interest rates go down, you're subject to that. But once you lock your interest rate, it would be, you're protected from whatever the market is doing at the time. So whether the interest rate goes up or goes down, you're locked in at a certain rate for a period of time. Typically speaking, locks can vary anywhere from 30 days, 45 days, and up to 60 days. Regardless of whatever the market is doing, you would be protected for that period of time that your interest rate is locked. And that's a conversation to have with your loan officer when you are at that point. Your loan officer will talk to you about what are the rates doing for that day? Is there a cost for you to buy that interest rate, or is there a credit for that interest rate for that day? And it varies every day. It's different. It changes. It can change multiple times in a day.
What type of mortgage is best for me? That's another excellent question. We as loan officers, we like to see your situation and we like to offer options for you. We cannot steer you to just have one option or maybe two. We like to present different options based on what we see on your credit history, based on what we see on your income, and based on what we can actually tailor it and structure. That's an important word that we use for doing the mortgage, structure. Structured correctly means we need to look deeply on what you think is gonna have a best benefit to you if you are looking for a mortgage. And so for some people, they say, well, I only have 3% down, I only have 5% down, I only have 3.5% down. I want my payment to be at this much. So we look up on those options and we have different type of mortgages for it. We can start with a conventional loan, which is, it's a little bit different, not because it's complicated, but it's because the credit wise. We probably have a higher requirements for a conventional loan. But there are some conventional loans that can start with 3% down, but it's gonna be based on your scores, on your credit score. Because if you put 3% down, you're gonna have what we call a mortgage insurance, and it's gonna be based on the amount of the money that you put in down. In this case, will be 3%, so you're asking for a financing of 97%, and that MI will be based on that down payment plus your scores. So if you have a minimum score, that MI can be pretty substantial. But if you have a good scores, yeah, that MI won't be as hard. But also we have another loans like Home Possible. We have banks and, as Terry explained, credit unions that actually can work with you on different programs that can help you. And we are one of them as a bank. But also, if you say, no, I want an FHA loan because my credits are okay, but not really up there. I just want to have to pay the mortgage insurance premium, and the mortgage insurance premium doesn't get calculated based on anything else besides your scores. And it's there, as we explained before, for the life of the loan. The only way you can get out of that a mortgage insurance premium is to refinancing and move to the conventional side. Of course, after you build enough equity, 20% or more in different ways, you can contribute more money to the principal and lower that. or you can actually go ahead and maybe you are in a location that is, you know, a big increase on value on the properties. You can ask for that mortgage insurance premium to be removed through refinancing. It's different when you're in a conventional because that is, you don't have to refinance. You can actually go ahead and wait, and that will disappear. That mortgage insurance will disappear eventually, but you can contribute also, making, you know, an extra payment a year, or maybe schedule yourself to make 2 payments instead of 1 every month and things like that. So there are so many different options that we can use for the type of mortgage. Again, it's gonna be structured correctly based on your situation. What are discount points and stuff like that? So discount points are actually, especially when you are purchasing a home, it might be recommended to do. You can actually have a better rate if you ask for discount points. But sometimes, depending on the size of the loan, it can be a little bit costly. And there are a couple things that you have always to look on this situation. One is your interest rate, and the other one will be your APR. The APR is actually how much it's gonna cost to do that loan. So when you ask for discount points and trying to reduce your rate to have maybe a better payment together, that APR will go higher because you will have to pay for those points. Points are based basically on the loan amount. Know the purchase price on the loan amount. And for example, if you are on a mortgage of $200,000, a discount point will be at least $2,000. And you have to be really cautious about this because sometimes to get you on that good rate, you might be surprised that you have to pay a certain amount of discount points just because you want a better rate. So you always need to have that conversation with your lender and say, if I want this rate, how much this is gonna cost me? And we're trying to make sure that we explain all those from the beginning so it won't be surprises. It's a very important document that you will receive in the beginning of your mortgage. It's called the loan estimate, and it shows exactly how much is going to be the interest rate and the APR, and how much is going to cost the origination and all those fees involved to get a better rate. Should I get 15 or 30 term loan? That's actually another excellent question. When you're trying to fit in a budget, and you're trying to get into a loan that it won't have a higher payment, a 30-year loan will actually be really beneficial to you because you are spreading the life of a loan for 30 years. Of course, you will see, oh, I'm only sending a little bit to my principal, I'm paying a lot of interest, but we're trying to just go ahead and make sure that it's not affecting you. Because when we look on your income, we want to make sure that you have enough money every month to pay your mortgage. A 15-year loan is also a good option, but is actually more expensive because you cut in the life of a loan 15 years or less. So 15 always will have a much higher payment, although the interest rate might be more attractive. And you see, it's a good interest rate. But why my payment is so high is because you have cut in the life of a loan instead to be at 30, you're saying 15. There are some other options too. You can do at 20. That's also available if you want to. There are some people that like to do a 10-year loan as well. But it's always going to be a higher payment when that term, the 30-year, gets reduced to 20, to 15, 10. And it's basically, you know, the borrower's decision to see what is more convenient. When you are on a 15, definitely you will get a much better interest rate because you are paying the loan quickly.
Okay, a question for Emilio. Do you use people with ITIN who are wanting to start their credit?
Well, that's an excellent question. people that have only ITINs, it's really important to start to build credit at the bank, starting with a secure credit card. If you haven't used for no other reason a different documentation, you need to have to start with a secure credit card and start to build some credit at your own bank. After you do that, you can go ahead and maybe start to use that IT for other credit. Normally, after 12 months that you have built a credit with the bank, and you can actually go ahead and get scores on your IT, and they will offer you, instead to be a secure, it's going to be an unsecured credit card, and you can actually go ahead and start to get some other sources, like going to a store and ask for a Visa unsecured credit card, and they will give it to you. It's always based on the credit history. So if you start with a secure credit card, that will be the best to get going with your ITIN number.
Thank you.
Hacienda
sorry.
does have resources for credit unions that offer credit cards and car loans for I-10 borrowers as well, to help them establish credit.
Next question. My husband has a Social Security and I do not. How does this affect our ability to purchase a home?
No, it doesn't. There are some programs that are portfolio on other places that you can go ahead and have both apply if you both are working, and especially if your husband has Social Security, and I assume is maybe a resident or a citizen, and you just can be add to it. But the only difference will be for those kind of loans to have a bigger size down payment. Normally it's about 10% down payment for those kind of loans.
Okay, thank you. What is the average percentage you have to pay extra if you don't have 20% down on the house? So I'm guessing they're talking about the private mortgage insurance.
Yeah, again, the private mortgage insurance, if that is the question, is based on credit and the amount of down payment. If you are only having 3%, you can still go ahead and get a lower mortgage insurance. But there are some institutions, the banks especially, that they can do lender pay MI. The minimum is going to be 5% down, and also you need to have a good credit history. For the situation that is going on right now, a credit over 720 will be required for the bank to go ahead and pay for that MI. So you don't need to be using that in a calculation. And the rate will be a slight higher than the rate that you see every day for a person that actually is paying the MI.
Okay. Is it better to go with a conventional loan over an FHA loan?
Of course, it's much, much better. The only reasons that you have to be directed for FHA is 3 reasons, and always put this in your mind. If you actually had these situations, a bankruptcy, a foreclosure, a short sale, or if you maybe think, I mean, my credit is not great, I have some collections, so you are actually saying, I need to work on it, but I'm still gonna buy a home. Those are the only situations that would direct you to FHA. But if you have a decent credit and you have a working history and you can have at least 3% down, a conventional will be a much, much better choice for you.
Is the Oregon bond part of the FHA loan, and does it work for first-time home buyers?
The Oregon bond is very much designed for first-time home buyers. And it is typically, it can be a conventional or FHA. There are certain lenders that offer the Oregon bond, not everybody does. The thing I would caution with any of the programs like that is there are requirements for these programs. There are income requirements. There are sometimes you have to reside in the home for a specific period of time. with these loans. Otherwise, there may be a repayment requirement. So regardless of the program that you decide to go with, it's very important that you work with your loan officer to determine what is the best program for you and make sure you understand what you're getting yourself into. And that's where you work as a team with your loan officer to make a decision on what is the best loan product for you based on your situation.
What does it mean to have decent credit?
Essentially, it means to pay your credit card, your car payments, anything that you show on the credit report, pay those things on time. Try to avoid things like collections, medical collections, any derogatory thing, like just make sure that you pay your bills on time.
If we have a recent bankruptcy, we will need to go through an FHA loan.
Yes, you have to. That's your only option. And you have to wait for a certain amount of time to qualify for the loan. Normally, the wait will be 2 years from the discharge date. If you file for a bankruptcy and you actually have, to go not by the date that you file, it goes by the date that the bankruptcy got discharged. There are so many different types of bankruptcy, so don't get confused about that. It's the different rules for a regular bankruptcy, but it could be Chapter 7 or Chapter 13. It's a different policy for the two of those kind of FHAs. Although, if you actually file for bankruptcy and you were a homeowner before, it's really important to discuss that with your loan officer, because if you have the house and it wasn't included on the FHA, you probably still making payments, it wasn't included on the bankruptcy, you're probably still having some issues there that we need to be aware of so we can correct for you. Well, what documentation should I gather? This is really, really important because for your loan officer to understand really your situation as income and your work history and how you have, a way to say, I have the capacity to pay for the loan, you need to have a detail of the documentation needed. First of all, your pay stubs, which is great to have because that will calculate how much money you're making so far for the year that you're applying for a loan. The other one is your W-2s if you are working for somebody else. And those W-2s are your working history. And with those W-2s, you are showing the lender that you have been on a job at least for the last 2 years and how much money you have been making. If you are a self-employee, it's important to have your tax returns. And on the tax returns, we will have to look to different things. And if you have a corporation, you have an LLC, depending of what kind of business you have, it's important for the lender to see your taxes. Now you need to prove that you are actually who you are. So we need your driver license if it's possible, because on your driver license, it shows your legal name. So we don't want to run credit incorrectly because we have a different type of name. Let's say a different name that you used to be called. Instead to be calling Francisco, they call you Pancho, and you like that name. No, we need to have that driver license, make sure that we have your legal name in place. If you are here just with a working visa, or you have just a DACA, or things like that, we love to see those to make sure that we put you on the right loan. The documentation will be also something that we need to make sure that we have it in place, along if you have a passport or something else to prove that you are who you are. Well, as we mentioned before, we need to have a source of where the money for the down payment is already located. So we're gonna ask for 60 days of your bank statements. And this is really, really important. If you really wanna do a loan, you need to prove where the money for your down payment is. It doesn't need to be appear suddenly from somewhere. You need to have a track of those. And the only way as a loan officers that we have to track those is to your bank statements. If you're receiving a gift from somebody, a relative, That's also allowed. And by the way, gifts are okay for paying the down payment on costs and prepaids. But you need to show that the money is coming from a sourceable source. What that means is paper trail. Paper trail means going from a bank to another bank. That is, get deposit on your account, savings or checking, and you need to have a paper trail for that gift. If you don't have a paper trail, if somebody is giving you money that they have at their house, that is gonna make things difficult for the loan officer to prove where that money is coming from. And you can actually be, generating a trouble yourself. And that goes to the last point, which is my source of down payment. And as Terry mentioned before, we have to be careful on the 401k or pension and things like that, because some people like to use money markets and have money on the money market that is at the bank, but we only, we can use retirement or pension things for a source of down payment. And this is the next slide.
So what is a pre-qualification? A pre-qualification is when you have a discussion with the loan officer, you're not providing any documentation, but you're just having a conversation. Nobody's pulling credit. You're just letting them know that you have a job history for 2 years. You have an idea of what your credit score is, where your down payment and closing costs would be coming from. The loan officer could then run some rough numbers and tell you sort of how much a monthly payment might be based on that particular day, based on what you've decided your credit score might be. They could tell you what an interest rate might be for that particular day. So there's no documentation, there's no pulling credit or any of that type of thing for a pre-qualification. Next slide, please. What is a pre-approval? A pre-approval is an actual process where you provide things like the documentation that Emilio just talked about. You're going to provide things like 30 days worth of pay stubs. You're going to provide 2 years W-2s, tax returns, 60 days of bank statements. So all of that documentation will be provided to your loan officer. They will then review all of that information, and then also they will be actually pulling credit. So that will show as an inquiry on your credit report. So I caution you to be careful about how many times or how many people you allow in this process to pull your credit.
If I take out money from my 401k, can I use that money as a gift or just use that money towards the down payment?
You have to be careful with your 401k for one specific reason. You have to check with the company that you have your 401k for how much money you are allowed to take out of your 401k if you are not on the age that is required for a withdrawal. If you take that money and you're not sure, and you can count on the money, you can say, I have 100,000, 50,000 on my 401k, can I use them all? Maybe your company won't allow you to take that much, and that can ruin your down payment because you will be surprised for those news. Always check on that. When you use the 401k also as reserves, because sometimes you have to have reserves for a loan, depending on the loan that you're getting into, you will have to prove if that is going to continue and how it's going to take, for you to use that 401k. Okay, let's get going. What is an escrow account? An escrow account is really important, depending because anytime that you have a financing higher than 80%, you will need to get an escrow account. An escrow account means money that's going to be paid through your mortgage payment, and you have to separate that money for taxes and insurance. And if you pay also mortgage insurance, is going to be in there. Normally, we have to take at least 12 months for the insurance. That's the whole year. And depending on the time of the year, you have to take also 6 months from your what's going to be your taxes for the property. So that's really important. There are some loans that for sure you need to have an escrow account. That's an FHA and a VA or a government loan. A USDA doesn't have that. But if you have a conventional, you can actually ask for what we call escrow waivers if you put in more than 20% down. How long does it take to close a mortgage? Well, it depends. Yeah, if you have your mortgage set out for 30 years, that's how long is it gonna take to pay that mortgage. But you, on these loans that we have available right now, there are no prepayment penalties. So you can pay the loan ahead. How you can pay your loan quickly. And that's really important to understand. If you get in a habit to pay your same amount, let's say your mortgage payment is $1,500 and you pay half of it every 15 days, no change in the loan amount, just paying half of it every 15 days, you should be able to reduce the life of the loan at least for a few years. Not a lot, but for a few. Also, if you do a savings through the year, and let's say I just got my taxes back, I'm gonna just send all that money that I received from my tax return to pay my mortgage. It's another way to go ahead and reduce that loan amount. Your payment won't change for the life of the loan. Just always remember, not because you're sending more money to the principal, you maybe having the idea, how come my loan payment doesn't change? No, your payment won't change for the life of the loan. If it's 30 years, it's 30 years, but you can reduce the term and you can pay it quickly because there are no prepayment penalties. Okay, how is my mortgage payment determined? As we explained before, we have the principal, the interest, the taxes, and the insurance. And those are regular what you have to pay, but you always have to add, if you are financing higher than 20% and you have to pay in the FHA case, a mortgage insurance premium, or if you have a conventional loan, you have to pay mortgage insurance, you need to add to is the principal, the interest, the taxes, and the insurance. And depending on the life of the loan that you choose, is always gonna be for a 30-year loan, you will send a little bit on the principal, more to the interest, and that can change only the payment because your taxes might go up a year. Let's say you started with the property that it was 200,000, and by the end of the year, or your first or second year, your property value, according with the county, goes up to 220. Yeah, you will have to pay more taxes, most likely. And that's gonna change your payment. If you have an insurance, and every year your insurance agent will call and say, we have to renew your policy because policies go for a year, and you add a little patio on the back of your house and you did some improvements, they will ask you for those changes. And if you are, saying, yeah, I need to insurance my house for a higher amount because I have more value in my house, that can change your payment too. But those are the things that you always have to consider. Your mortgage is gonna be structured that way. Principal, interest, taxes, insurance, and also your MI or your PMI.
Hi, so this is Guillermo Salazar with Country Financial. Today we'll be going over the fundamentals of home insurance and why it is critical to have home insurance. So I will be moving on in English, and today we will be talking about why we need home insurance. First and foremost, your lender, whoever that may be, your mortgage lender, will require you to have a home insurance policy before closing on a home. And so you most likely, if you already have a mortgage, you already have situated your insurance. But if you don't, contact someone, an insurance advisor, to get that home policy. Oftentimes the bank or mortgage lenders will place their own insurance policy on the home, and that typically is way, way, way more expensive than it needs to, as opposed if you were to go to an insurance advisor and get a quote from them, get a policy from them. So I always encourage my clients to go look for an advisor when you are searching for a home. The biggest reasons you need homeowners insurance are you need to protect the structure itself and the possessions that you have inside your home, inside the walls. Today, we will also walk through the home insurance application process. I know there is a lot of first-time home buyers in attendance, so I will explain before the presentation is over, really what is the process to get that homeowner's policy. So obviously moving forward, what other things we need to ensure? So we have to make sure that other structures are insured, such as a detached garage, or if your home has a shed, we need to make sure that is properly covered in case of, of a fire or any claim or tragedy that happens. So, let's see here. As well as our personal belongings, we have to make sure that, obviously we keep track of, how much things we have. Every single family, every single house is uniquely, will have unique needs. So it is very important to meet with an insurance agent or advisor to address, how much do I actually have at home? A lot of people do not really think, they either undervalue what they have inside their home, and a lot of times when these, tragedies happen, when you have a loss at home, they're not properly covered. So it's very important to meet, annually with your insurance agent or advisor to really address how much personal property I have inside my home. Moving along as well, your liability coverage can protect you against pretty much any bodily injury or property damage for which you're responsible for. For example, an example I like to use, if you have the kids over and you have a trampoline in your backyard and your neighbor's child gets hurt, in your home insurance policy, you have coverages like medical expenses that cover the damages occurred on your property, and it also protects you from any legal repercussions from any really lawsuit. So it is important, and a lot of people didn't know that, oh, I have medical expenses coverages that I can use in case someone in my property gets hurt. A lot of people don't know they even have that in their homeowner's policy. So I encourage all of you today to either look through your policy or contact your insurance agent, contact myself to really explain what is actually in my policy. Next slide, please. Within our home insurance policy, we will also have some optional coverages. These optional coverages include a personal umbrella, which is really a liability policy that covers a lot more than your typical, home insurance policy. This will protect your assets far more than just your regular home insurance policy. That is very popular with our business owners. A lot of our business owners obviously have more in assets, so we need to be able to protect, those clients that have more assets with more coverage than just your typical homeowners coverage, as well as some optional coverages that come with a home insurance policy is earthquake coverage. That is optional. That really is personal preference, up to you. Another one is identity theft. A lot of people don't know that this coverage is in their homeowner's policy as well. They didn't know that, you have coverage in case your identity gets stolen. Those instances usually are very costly when that does happen to you. And, I am glad that we are able to provide optional coverages for our homeowners and that, have to deal with that instance. And it really could be saving you a lot of money if you review these optional coverages very carefully. So another point to why it is important to really meet with your insurance agent to specifically address, those needs, those assets that you have. And obviously we have jewelry and watercraft and a recreation motor vehicle, which can include, a boat, jet ski, anything along those lines. Really, these are all very unique. So I would, again, say, if you didn't know, for example, that, you have jewelry coverage in case of a claim. So for example, your house were to get, burned down or anything along those lines, how much do you really have of jewelry? I know jewelry is something in our culture that, a lot of people, it's just part of our culture. Jewelry is very popular within the clients that, that we serve. So it is important to talk to your agent about, these optional coverages that typically most people don't know that they are included in your homeowner's policy. Next slide, please. All right, and lastly, we will be going over ways to save. But before that, I wanted to really walk you folks through the process of, how do I even get home insurance policy? How does it work? So really how I will start this example from the, viewpoint of someone who is looking to buy a home. So a first-time home buyer right now. Really, all you have to do is contact an insurance advisor, insurance agent, and let them know that you're interested in a quote. And then after you get in contact with that insurance advisor, with that insurance agent, they will be in contact with your mortgage lender. So for example, my good friend Emilio that just went through everything mortgage and how to acquire a loan, me and him will work together as a team to really finalize your insurance policy. The biggest thing is communication and really sitting down with your insurance agent to talk about your specific property, your specific personal property, your specific home, if it has a shed, if there's other things on the property that we need to insure. That's really the most difficult part. And it's really not that difficult if you have, a very communicative insurance agent that, you can trust and that they'll be able to communicate with you either in English, Spanish, no problem. And so the next step I would say is, obviously it's the meeting with your insurance agent. You walk through, the specifics of your home, if it's hardwood, if you have, smoke detectors, if you have a central burglar alarm, any specifics of your home, you disclose to your insurance agent to be able to write a quote for you. And then after that, really all it is once we go through all your specifics of your home, we agree on the quote. And really at that point, that's really the end of it. We collect some signatures, obviously, but then after, we agree, we find the right coverages for you, the right policy for you, me and your mortgage lender will be in contact and we finalize the rest. So it really isn't that difficult. The difficult part is really meeting with your advisor and going through everything you have, all your specifics of your home. And then, me as an insurance agent gets in contact with your lender. And then from there, we just keep in communication and we finalize the policy. That's all it is. You do not have to pay anything directly through me. If you have a escrow account, your insurance payment will be included in that escrow account that you pay on your mortgage monthly. And so lastly, as I was saying, well, I'm just going to walk you through some really simple ways that you can save on your home insurance policy. So for example, obviously we have a multi-policy discount. For example, that can include auto and life insurance. That just we just provide you with more discounts at that point for having us protect really every aspect of your financial life. And then other ways is obviously raising the deductible, smoke detectors, fire extinguishers, sprinkler systems. If you have in your home fire safety measures, fire safety alarms, that makes it easier for us. So we give you a discount. And also, if each one of you has a different home year. If for older houses, we got to make sure that if the plumbing or heating or electrical have been upgraded, that we have that on file, so we can provide you with a discount. There's opportunities for discount depending on how new or how much of an upgrade you have done.
Okay, so Hacienda has a variety of programs that we can assist with down payment and closing costs. We have an IDA account, which is called Individual Development Account. This is a matched savings program. This is for first-time home buyers, specifically in the state of Oregon. So there are income requirements that have to be met for this program. There are also asset requirements. So you cannot exceed $20,000 in assets in your account after your down payment and closing cost. So as an example, if you save a maximum of $3,000 over the course of a certain period of time, we would match it with $9,000. So you would essentially have $12,000 to use for down payment and closing cost with this IDA account specifically. So we've talked about all of these different programs having income requirements. So this is something that when you sign up for Hacienda services, you meet with the counselor, they're going to go over these types of things with you to see if you're a good candidate for these programs. If so, it's a separate process with filling out applications, providing documentation such as income, that type of thing, and your counselor will go over that with you to determine if you are a good candidate for those programs. Also, Hacienda, from time to time, has access to down payment assistance funds. So currently we partner with Oregon Housing and Community Services and also Portland Housing Bureau. When we do have these funds available, they are on a first come, first served basis. These loans are zero interest loans and they are amortized anywhere from 5 to 30 years. They can vary between income requirements of 80% median family income up to 100% median family income. Again, these are conversations that you would have with your housing counselor to determine if you are a good candidate for these types of programs. You do need to be registered as a client with Hacienda. Hacienda does charge an application fee of $75. And these down payment assistance funds can vary anywhere between $15,000 and up to $60,000. Next slide, please. So how can Hacienda help you achieve your goal of buying a house? So some of the things that you would do is register with Hacienda, as we've talked about. And when you register with Hacienda, one of the services that we offer is that you'll actually be meeting with a home buying counselor. Those counselors are going to go over in detail with you your budget, your credit report. When we pull a credit report with the pre-purchase counselor, this is called a soft touch credit report. This does not show as an inquiry on your credit report, but it does show what your all three scores are from all three bureaus. And so it gives you an opportunity to have that discussion with your counselor to determine if your credit score is high enough to meet the requirements for homeownership. They go over budget with you extensively, and then they talk to you about all of the programs that Hacienda has that you might qualify for. We also have a list of participating lenders and realtors that we work with that are very knowledgeable about all the down payment assistance programs that are available. Next slide, please. Do you need to be a Hacienda resident, client, or a first-time home buyer to get a mortgage specifically through Hacienda? The answer to that is no. We can assist anybody with mortgage financing needs if it's your first-time home buyer, if you're looking to purchase a second home, if you are an investor, or if you want to refinance. We are here to help you with that as well.